Hi there, welcome to Kneppy Invest. Whenever I first sit down and start researching a company, the first thought that comes to my mind is whether that said company is high quality or low quality. Now, the quality spectrum is quite broad, and the said company could fit anywhere on that. But I really want to understand whether this company could be a long-term hold or just a trading stock, which I do with low quality companies. So the first thing I always do in determining whether a company is high quality or not is look at the revenue growth. That is absolutely the first step I always take, because if a company can't grow their revenue, it's out the door. It cannot be considered a high quality company. So in this video, I'm going to explain why I consider growth to be so important in determining whether a company is high quality or low quality. The motivation for me doing this particular video is from a comment I did receive in regards to quality and growth from Impermanent Being, who stated that quality and growth are completely different metrics. Now, technically they are right. Quality and growth are completely different metrics. For instance, when you look at the quality of a company, you need to look at many different facets of the company, not just growth. You need to look at margins, or maybe you need to look at return on equity, return on invested capital, the moat of the company, management of the company, total addressable market, many different things you probably need to look at. But in my opinion, if you completely ignore revenue growth or even earnings per share growth of a company, when you're trying to understand the quality or where a company fits on the quality spectrum, that is a mistake. Now, in saying all that, I would consider growth and quality to be intertwined. So they are different, but they're intertwined. So I would consider, by my definition of quality, that all 100% of quality companies need to have good, reasonable revenue growth. At least 5% revenue growth per year, preferably about 10%. I'll take between 5 and 10%. If I see a company growing their revenue at, say, 2 to 3%, that is not quite high enough, because you do have to take inflation into account. So that really means companies like Woolworths, straight away, not high quality for me, because revenue is not growing at a good rate. So that is why I would never consider banks to be high quality. Revenue growth is really slow at this point in time, and it's been slow for the last 10 years. Woolworths not high quality. Telstra definitely not high quality. They're not growing their revenue at all. So revenue growth is vitally important for me in determining whether a company is high quality or not. It's the first thing I look at. And then after I look at the revenue growth, then I go on to looking at stuff like margins, gross margins, return on equity, return on invested capital. I might have a look at total addressable market, moats, which I can sort of determine just by gross margins. Look at the management of the company, that sort of thing. But in my opinion, by my definition, all quality companies need to have good revenue growth. But in saying all that, not all growth companies could be considered quality. In fact, there are plenty of highly growing, quickly growing companies, and not only on the ASX, but also on NASDAQ, New York Stock Exchange, that are growing their revenues at phenomenal rates, but I would not consider those companies to be quality. And the simple reason is because they're not profitable. And they might be quite a few years from profitability. I need to see a few years of profitability before I even consider a company to be high quality. So not all growth companies are or should be considered quality. So you might hear me talking about growth and high quality all the time. So why are these two things really important as an investor? Now, if you asked 1,000 investors what their investing objectives were, you're probably going to get a lot of different answers, but most of those answers are going to be fairly similar, even if they're said and written or mentioned in a different way. So these are my 3 investing objectives. And I think the importance of one of these investing objectives is going to be a little bit different for everyone. Now, I focus on the left too. So I focus on growing my capital and protecting my capital. I have very little interest in income at this point in time. That probably will change once I retire, and income will become a little bit more important. But you just look at the first word, growing capital. So that should be one of your main objectives. In fact, if I was 20 years old again, I'm not that much older than 20 years old, that would be my main focus. In fact, I wouldn't care about protecting capital at all because I wouldn't have much capital. And income, who cares about income at that point in time? It's all about growing your capital. And I'll talk about the best way to grow your capital during this video. But as you get a little bit older, get a little bit more experience, and your capital is growing through time, you come to realize that protecting your capital is just as important, and possibly becomes even more important once your capital grows to a fairly sizable level. So growing your capital, you're protecting your capital, becomes different sort of priorities depending where you are on the investing journey. And then finally, income becomes fairly important once you rely on your investments to live your life. But even then, I think growing your capital and protecting your capital are and can be still quite important. Now, let's just talk about the definition of quality. And this is a very simplified definition. In fact, I had this definition and I just included the last four words. So, in my opinion, the definition of a quality company is one that can help grow and protect your capital over the long term. And I think that's very important because sometimes a company can help grow and protect your capital over the shorter time, and that can be a low quality company. And in fact, that's what I do. I trade those sort of situations, but those sort of companies and those sort of trades aren't for the long term. So in my opinion, and the reason why I tend to hold high quality companies in my super, because I tend to hold those companies for the long term. So a company that can help grow and protect your capital over the long term is, my opinion, the basic definition of a quality company. Now, when it comes to an investor and you want to grow your capital, one of the, if not the most important word or concept to understand is compounding. In fact, the best compounders are growth companies. Now, I'm going to be talking about why and show you examples why compounding is vitally important when it comes to growing your capital, particularly if you're a younger investor. Now, as you get older, I suppose it does become a little bit less important, and also protecting your capital is a little bit more important. But even when you're a little bit of an old fart like me, growing your capital is still quite important. And I'm still looking for these potentially great compounders that can be significantly bigger in the future. And the best way to get these really great compounders is looking for companies that are growing their revenue, or hence are growth companies. Back in 2021, I looked at two companies and I compared these two companies because I just wanted to see what the difference in returns were if invested in a non-growth company versus a growth company. And the best example of a non-growth company I could think of back then was Telstra. And one of the best examples of a high-quality growth company on the ASX, of course, is CSL. So what I did was a little bit of an exercise just to see the type of returns you could imagine if you invested when Telstra went public back in 1997. Now, have a look at the revenue of these two companies over the last 20 years. Telstra has not grown the revenue at all. At all. From 22.7 billion in 2005 to 22.9 billion in 2024. That does not mean they can't grow the revenue over the next 20 years. Who knows? Maybe this will become a growth company, but they have shown no proof over the last 20 years that they can grow their revenue. So Telstra is a definition of a non-growth, low-quality company. Because low quality, because they can't grow their revenue. And you'll be able to see the difference in returns of these two companies. Now, CSL is the definition of a growth company. Look at their revenue. Revenue in 2005, 2.8 billion. Revenue in 2024 up to 14.8 billion, which means they have increased their revenue fivefold over that 20-year period. So which would you prefer here? Telstra, no increase in revenue at all, or CSL have increased their revenue fivefold? So if you can answer that question, then you can answer the question, which is better, a high-quality company or a low-quality company, a non-growth company or a growth company. Now, you might be saying, well, what about the dividends? Well, I'm going to show you the dividends you would have accumulated by owning these two companies over or since Telstra listed on the ASX back in 1997. Now, before we get to the dividend portion of this video, and I do think there's going to be quite a few people shocked at the accumulation of dividends since 1997 for these two companies. So let's go back to my example in 2021. And I assumed, and I used two people, myself and my friend, I assumed that one of us bought 10,000 shares in Telstra and the other one bought 5,000 shares in CSL. And the reason there was a difference there is because CSL was almost the double share price of Telstra. Now, the reason why CSL share price in 1997 is $2.92 is because the company did have a stock split. I think it was a 2-for-1 stock split. So in 1997, if you take that stock split into account, the share prices were fairly similar. $2.70 for Telstra, $2.92 for CSL. And over the last 28 years, Telstra share price has risen from $2.70 to $4.14. So it's a 53% gain over a 28-year period, which means the CAGR, just in the share price, is 1.54% per year. So that's not great. Now for CSL, share price back in 1997, $2.92. Now it's $256.80. That is 8,695% increase in just the share price, which is a CAGR of 17.3%, which is something, that is sort of a name a lot of investors, particularly private investors, try to achieve. So I am aiming for 20% returns per year. So CSL is fitting in that criteria just with their share price. Telstra is not, nowhere near that. Now, if you use my example and someone bought 10,000 shares of Telstra back in 1997, the value of that holding in 2025 is 41,400. But if they bought the same valued of shares of CSL back in 1997, that value of CSL shares right now is $2.57 million. Yes, $2.57 million. So you can just see the difference in returns of these two companies over a 28-year period. One is a non-growth company, the other one is a growth company. One is low quality, the other one is high quality. So hopefully you can see the difference between low and high quality and why high quality companies should be a preferred long-term holding in your portfolio, just with the share price performance. But what about dividends? I can almost guarantee you that back in 1997, when Telstra went public, there were quite a few investors who compared Telstra to a company like CSL and thought, yeah, Telstra is a better quality holding investment because it has a higher dividend and higher dividend yield than CSL. You might be laughing at me when I say that, but I actually do know some people who just look at dividend yields in deciding whether a company is a quality stock. And I do think that is a mistake. And this is a great example of why. So this is the dividend history of both companies since 1997. So dividends started in 1998 because that was just after Telstra went public. Now in 1998, Telstra had a dividend. Now this is based off that $27,000 invested in both companies. So Telstra had or provided their shareholder with $1,400 worth of dividends. CSL only $900. So Telstra had a better dividend payout than CSL. But again, it's a non-growth company. CSL is growing. And one of the main features of a growth company versus non-growth company, if they do both provide a dividend, is much more likely the growth company will increase their dividends over time compared to the company that is not growing. And you can definitely see that here with the dividend history of both companies. Now, Telstra dividend didn't exceed Telstra's dividend until 2006, and then it accelerated away while Telstra dividend actually went down. And in 2024, CSL provided that shareholder with $39,740 worth of dividends in the 1 year. So that means if you compare that dividend to the original capital put into the company, it's greater than 100%. And this is my long-term goal. This is my dream scenario where the dividend of a company is providing me with a greater amount than the initial capital I put into that company. Now, I would expect that to mean I have invested in a company for over 20 years, but this is the absolute dream that I'm aiming for, that the dividend a company can provide me with is greater than the initial capital. Now, compare that to Telstra. Dividend in 2024 was $1,800, barely grown at all since 1998, and has dropped by half since 2005. And the accumulated dividends that Telstra has provided their shareholders since 1998, $65,250, compare that to CSL, $347,000. So this should really exemplify why, even if you're an income investor, why looking at growth can be and should be really important. Now let's turn our attention to the power of compounding. So what I did here, and I used this or took this from my video back in 2021, what I did here is just looked at the difference between, over a 30-year period, a 20% per year or CAGR versus 10% CAGR versus 5% CAGR if the initial investment was $10,000. Now, it's really interesting that Telstra's CAGR, if you include dividend, over the last 30 years or 28 years, has been about 6% per year. And there would be some investors out there who'll be very happy with that. Yeah, sure, 6% per year, that's great. But there's a massive difference, a huge difference between a 6% per year return and a 20% per year return, which CSL has provided their shareholders over the last 28 years. So just have a look at the year 30 number here. So if you're compounding $10,000 at 20% per year, by year 30, that $10,000 has grown to $2.37 million. Now, if you're happy with an index, so ETF getting 8% return per year, very happy with a 10% per year, that original $10,000 has grown to $174,000, almost $175,000. That's a huge difference. What would you prefer? 2.4 million or 175 million. Now, if you're just happy with Telstra, all you're getting is $43,000. So are you happy with $43,000 compared to 2.4 million? So this is really, this showcases why a lot of private investors like me are aiming for 20% per year, because it makes a difference. And it makes a difference because your main priority as an investor is to grow your capital. And if that is your main objective, what number are you going to be aiming for? 2.4 million or $40,000? So hopefully I have explained well enough why growth is so important and why growth is one of the first things I look at when I am considering the quality of a company. Okay, so if you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.